Hi, and welcome to our course on investing strategies. Here we will look at 5 different strategies you can deploy depending on the market conditions or your investing style. And while these strategies are well proven and used by professional investors everywhere, it's important to understand that no strategy works 100% of the time. The key here is understanding exactly how to deploy each one, when to use them, and how to make them better. So let's get started. First up is value investing. Value investing is a very simple idea. Basically, you buy €1 worth of assets for less than €1. So you're looking for companies trading below their intrinsic value, usually because the market's ignoring them or they're temporarily out of favour. Here's how to deploy it. First, use a stock screener such as FinViz and filter for low PE ratios, say under 15. Some low price to book ratios under 1.5. And positive free cash flow. Look for companies with strong balance sheets that the market's just not excited about. Warren Buffett built his fortune famously buying Coca-Cola when everybody thought carbonated drinks were dying. Now, Coca-Cola is a value stock these days and wouldn't be considered a value investment as it is priced fairly in the market. However, back when Warren Buffett bought it, it was considered a value investment, as it had fallen out of favour with the share price below its intrinsic value. A value stock is not to be mistaken with value investing, which is where a mature company with an established market share and competitive advantage, or a moat, as Warren Buffett calls it, and it prevents it being overtaken by competitors. It's a money-making machine that pays dividends to its shareholders. So they're value stocks as opposed to value investing. And Coca-Cola, Walmart, and Berkshire Hathaway would be typical examples of value stocks. Whereas value investing is about finding undervalued stocks. And value investing works brilliantly in bear markets and sideways markets when growth stocks are getting hammered. But you need patience. These positions can take years to play out. And to refine it, you can add a quality filter, look for companies with return on equity above 15% and manageable debt levels, and that will really refine your filtering in your screener. So you want cheap and good companies, not just cheap companies. Our next strategy is momentum investing. Momentum investing is the opposite of value investing, where you're buying what's already going up, betting that the trend continues. It sounds counterintuitive, but markets actually trend more than they mean revert, meaning that they are on trend more often than they are not. To deploy it, screen for stocks with strongest 6 to 12 month price performance, say 20 or 30%. You can increase or decrease this to refine your results. You want consistent upward trend, not just one-off spikes here. So look for stocks breaking to new 52 weeks highs and increasing volume. To determine increasing volume in your screener, use the relative volume option with a value greater than 1. It's most effective in bull markets and when clear trends are established. The risk is you're buying high, so when momentum peaks, the price can fall significantly. To refine your investment strategy, you could combine it with the relative strength index, the RSI, set at not overbought 60 or 70, meaning that the upper trend still has a way to go. You want stocks to outperform on multiple levels here, so you're picking a variety of different criteria. Also, use a trailing stop loss of maybe 15 to 20% to protect profits when the momentum inevitably reverses. And be wary of stocks that just keep rising without any pullback. You don't want to buy just before the price reverses. Moving on to our next strategy, we have the RSI and PEG strategy. This is a really great strategy for combining technical and fundamental analysis. The RSI, or Relative Strength Index, measures whether a stock is overbought above 70 or oversold below 30. And the PEG ratio divides the price earnings ratio by the earnings growth rate. Under 1 is typically considered undervalued. So the PEG ratio is a better ratio for comparing earnings across different industries as it accounts for growth thereby allowing you to compare a company in a high growth industry like AI against a company in a low growth industry like utilities. So here's how to deploy it. You want to screen for stocks with RSI below 30. They're technically beaten down. And then you also want a PEG ratio under 1, meaning they're fundamentally cheap relative to their growth. And finally, include a current ratio greater than 2, meaning that they have a strong balance sheet. So you're finding quality growth companies that have temporarily sold off. Think of a strong tech company that drops 20% on a disappointing quarter, but still has 20% annual growth prospects. So this works really well during market corrections when quality companies get caught in a broad market sell-off. But it's less effective in strong trending markets where everything is expensive. Our fourth investing strategy is the Golden Cross strategy. And this is when a stock's 50-day moving average crosses above its 200-day moving average, and it signals a potential major trend change from bearish to bullish. And institutions watch this religiously all the time. So to deploy it by setting up your screener on platforms like Finviz or Yahoo Finance, or your broker platform may have an alert system that can alert you when a Golden Cross forms. Then verify with a volume criteria in the screener. You want the cross accompanied by increasing trading volume, showing that there's conviction there in the chart move. It's more effective in trending markets and works better on liquid large cap stocks. Small caps can bounce around with more volatility, so the moving averages are less reliable. The downside is that it's a lagging indicator, so you're never catching the absolute bottom. To refine it, don't take the Golden Cross blindly. Check the broader market trend. The Golden Crosses work better when the overall market is supportive. So look for the slope of the moving averages in the charts. So steep angles indicate strong momentum, and combine it with some fundamental screening. Only trade Golden Crosses on companies with solid earnings and growth and manageable debt. So they've got to be a fundamentally sound company in the first place. So to really secure this strategy, you could add the actual price line onto the chart as well. So that the price, the current price, would be above the 50-day moving average, and that in turn would be above the 200-day moving average. And now you have identified there a really established upward trend that you can buy into. Our final strategy is sector investing. So this is all about rotating your money into the sectors that perform best at different stages of the economic cycle. For example, technology and consumer discretionary stocks lead in early recovery, industrials and materials in mid-cycles, and energy in late cycles, and utility, healthcare, and these types of stocks in recession. So deploy this strategy by tracking economic indicators such as GDP growth, unemployment, and interest rates to get an idea of the economic direction and where in the cycle we are. When the economy is accelerating, shift to cyclical sectors. When it's slowing, move to defensive, and use sector ETFs for easy diversification rather than hunting around for individual stocks. Finviz has a very good graphical display of how sectors are changing through the year that helps you focus on which sectors are performing and which are not. And justetf.com is a good website to search for ETFs by sector. You can go onto that site, filter by equity, and then filter again within equities by sector. And you'll find that there are over 400 different sector-specific ETFs. And remember, with ETFs, the Irish government has cut the exit tax from 41% to 38%, which is good news for investors and makes ETFs a lot more of a better investment than they were previously. So this strategy is highly effective over the full economic cycle, but requires you to actively monitor and rebalance because it's over such a long duration. So to refine this, track the sector ETFs performance weekly. Also consider subsectors for more precision. So within technology, for example, semiconductors might be outperforming software at different times. And you can find a specific semiconductor ETF if that's the way you want to go. But it's best not to abandon sectors completely. So you don't want to rotate completely out of a sector. You want to keep some exposure to all sectors, but just overweight the leaders. Finally, watch out for central bank policy. Rate cuts typically favour growth sectors, while rate hikes favour value and defensive stocks. So there you have it. 5 battle-tested strategies you can start using right now. And remember, no strategy works 100% of the time, and no strategy should be used in isolation. Always consider the wider picture, such as relevant news and the overall industry that you're operating in, and the macroeconomic backdrop.